Welcome to lesson 1, part 5 of the 8 stock investing categories series. I'm your teacher and mentor, Mntom'nyama. In this video, we are going to talk about the next category, which is called deep value stocks. Now, before we begin, I would like to make a disclaimer. This is not a stock category I like, nor would I recommend it to you guys. But so that your knowledge is complete, let us briefly go through it. This deep value strategy was used by Benjamin Graham, also known as the father of value investing. Warren Buffett, his student, also used it at the beginning of his investing career, but obviously he stopped using it a long time ago. In this strategy, one buys companies that are not very good. These are not great companies. They are actually average or mediocre businesses. Hence, this strategy goes against the investing philosophy of this course, which is why I don't recommend it. But then you ask yourselves, why would an investor want to buy a mediocre business? It is because it is so cheap that if the company were to close down, he will get more money than what the business is selling for at that particular moment. This is also known as cigar butt investing. For example, if a person smokes a cigar until it is almost finished and then throws it away, you then come along, you pick up the cigar butt and smoke it for one last puff. For these stocks, the share price is selling for less than the net cash on the balance sheet. So if you buy the business at this price, one effectively gets the business for free because the company has more cash on the balance sheet than what you paid for the business. Bear in mind, these are usually businesses which are in industries that are in distress. Companies experiencing temporary problems, such as a recession in that particular industry. It is important to note that even though the companies you are buying may not be doing well, they still have to be making some money in order for us to consider it. But then you ask yourselves then, when do we buy? We buy when the share price is selling below their net working capital less long-term debt. So if the company is closing down, what do investors get? We get the assets of the business minus all the debt. This equation basically tells us what is the value per share if the company were to close down. In other words, what is the amount of money we can get back? These deep value companies may not have a strong economic moat, so care must be taken not to invest in businesses whose product is becoming obsolete. Avoid these mediocre businesses, even if they are selling very cheap, as the value of the company is continually being eroded. This is also called sunset companies because these companies are on their way out. So do not use this method in sunset industries on companies who are selling a product or a service that is becoming obsolete. So when you invest in deep value stocks, again, you have to exercise patience. Do not expect the business and the share price to recover quickly, as it may take several years for it to recover from its deep troubles. That is why I do not like this category. So let's talk about the entry criteria. What conditions must this stock satisfy for us to start buying? Number one, it must have a positive cash flow from operations for the last 12 months. Number two, it must have conservative debt. In other words, the current ratio has to be greater than 1. The debt to equity ratio has to be less than 1. And the debt servicing ratio has to be greater than 30%. Number three, the share price has to be less than the net working capital minus long-term debt divided by shares outstanding. So whatever value you get from this equation, the share price has to be lower than that figure. Number four, we want to buy when the price has dropped to a level of support or reversing into an uptrend. When do we exit? We exit when we see that the share price is reversing into a downtrend or if the company reports a quarterly loss. We do not want to hold these stocks for long. And as we close, if you want to find these types of companies, you can subscribe to websites like Guru Focus and use their screening software to identify these companies.